Hello, everyone, and welcome to the Wealth Wednesday show once again. We are super excited to see you today, and we hope that you are doing well and keeping safe wherever you are. Today, as earlier advertised, we are going to discuss on the things you need to do before buying stocks. If there is something we've learned from the stock market last year, it's having knowledge before buying any stock or before getting in the stock market. We've seen the market last year indicating various aspects that led to some people realizing they were not risk takers and others became more risk takers. So we don't want to repeat the same mistakes we did last year, or we don't want to experience the same anxiety we experienced last year. And that's why we are going to have today's topic so that we can get to learn, what do I need to know before I rush and buy stocks, before I can click on that ad that is telling me buy stocks for ABCD and make this amount of money. What do I need to know? What is my responsibility? What should be my expectation, so that you don't end up having, I call it a stock market shock. You need to get a stock market shock absorber. So with us in the studio is none other than J.J Wenrich. He is an author, a financial literacy advocate, as well as an investment manager. He's also the founder of Wenrich Wealth Management Company. He will be telling us more about himself. So today we are so honored to have him in the house. He has vast experience of over 20 years in the market, especially the financial market. So he's going to share with us some of these nuggets that we need to have so that we don't end up repeating the same mistakes. Or if you haven't made any mistake, you need to learn from him. So JJ, feel welcome. Maybe you could share with us a little bit more about yourself.
Thank you, Sheila, so much for having me on your program. I love what you do. I think it's so wonderful that you share the message that you do with your audience, because it's a message that often it doesn't get out there unless people almost seek it out, and oftentimes it can be hard to learn. So I just appreciate the way you approach the topics. So thanks for having me. A little bit about myself. I have been interested in the markets since I was pretty young. I first got interested when I was in seventh grade. So when I was just barely a teenager, and really have followed it closely my whole life. But one thing I had noticed along the way is that like anything that you specialize in, and there becomes a different language that people that are outside of that circle, they don't always speak that same language. And with the stock market, I feel like there's so much of that. And just part of my mission of what I'm trying to do is make it so that it doesn't seem like such a intimidating topic, that it's not such a foreign subject, that it's something that people feel like, I don't need to have gone to school for that to know that. In fact, a lot of the best money managers, investment people that I've ever come across did not go to school for it. And so just want to try to get that message to folks that might not get it otherwise.
That is very true. I actually agree with you on, I always say that, having a degree or an education background in finance is not equivalent to being financially educated or financially literate. So, and I like the fact that you said your main vision is to break down the financial jargons to simple terms that the market out there can understand. We are in a generation where when you touch the topic of money or finance, especially stock market, people cringe back and they're like, "Whoa, that is so risky." Because the gospel that have been put out there is stock market is so volatile, don't go there. It's like, don't touch this. But I like what you're doing. You're trying to make people embrace this kind of market as well as start investing in it. So without taking much of our time, we'd go right into today's question. Maybe JJ, you could help us understand what is a stock and maybe explain a little bit more about a stock market, especially to the person who is watching us and has never heard of a stock market or even participated in one.
No, absolutely. Looking forward to it. And I'm actually going to touch on something that you just said, where you said that a lot of people, they maybe have one of two approaches or experiences or mentalities around the stock market. One, kind of like you said, they're like, oh my goodness, it's so volatile, so risky, don't go there. And I think that the first thing I would say as someone who's someone who gives advice to, investment advice for a living, is it is very risky and it is very volatile. And I think it's important that going into it, that you acknowledge that, because I think that helps set the stage, that you have the right frame of mind and you do the right things to approach it in a prudent way, because it is risky. Because the problem that comes along is when people don't respect it for what it is and just start going, hey, I'm going to put this money in and I'm going to make all this money, and then it goes down and they lost their money. And like, well, what happens? And it's like, well, if you didn't approach it with care, what did you think was going to happen? If you don't know how to swim, don't go jump out into the big waves. Learn how to swim and then work your way until you kind of know what you're doing. And so I try to, I think that it's important that you do talk about risk, because when you're talking about the stock market, anybody that's been involved in it any length of time will say, yeah, it is risky. And so you just need to give it the respect that it deserves, and then set up the way you approach it in a certain way so that risk works for you and you don't hurt yourself. And so hopefully as we talk, I'll kind of get to that point where I show you what I mean by that. But kind of coming back to your question, what is a stock? What is the stock market? Here's how I've approached that, answer that question to both young kids, but also folks in their 40s, 50s, and 60s. There's no shame in not knowing these things. If you don't know, you don't know. Stocks are just companies. If you own shares of in a stock, it's your share of the ownership of that company. And it may come with different voting rights, different things like that. But in essence, you're an owner of that company by whatever percentage your ownership represents. And so there's no difference between, any business you might see in your home or neighborhood versus a business that is actually publicly traded in the stock market. The difference is one is public and one is private. And so if they're publicly traded, it means that you can buy those companies if you have the money to do so. So what is a stock? It's a company that it represents ownership in a company that anybody can buy or sell. And what is the market? It's just all of those. It's all of those companies together. One of the lines I like to use is, the stock market, it's not just this one big thing. It's a market of stocks, a collection of companies. Now, oftentimes those prices move up and down together. If the market's up or the market's down, your company might be up or, it's probably going to be up or down with the market on any given day. Because, the whole market's reacting to news, but, over time, each of those companies is going to kind of move on their own individual path. So it's not just this one big foreign thing. It's, it's companies. And if the outlook for companies is getting better, then the prices of those, if the business is better, then the prices of those companies have a better chance of going up. But in its simplest form, just try to, take that layer of complexity back. Don't think about it as stocks and having to know all these things. Start out by, looking for just the companies that we all recognize.
Absolutely. I totally agree with you that stocks are just companies. It's just the same way we can say we have certain shop for a certain, like a clothing industry. We have shops that sell different kind of clothing. So stocks are just companies, and then market is the normal market when companies come together to, trade. But we're gonna get there. And I also like the analogy that you gave, that if you do not know how to swim, don't start with trying to dive in the water. Start by learning how to swim. I would say start by learning how to float, then go as you progress. Then you can now go, and after you've learned how to float, maybe in a swimming pool, now you can go ahead and even try swimming in an ocean. So to our audience, thank you so much for tuning in. We really appreciate your presence. Feel free to write us any question that you might be having regarding the stock market, or any question that pertains anything to do with investing, as well as if you have any question on how you can teach your kids how to buy stocks, this is the right uh, platform for you to ask your question, as JJ is an author of a book titled Teaching Kids How to Buy Stocks. I know he will talk about it later on. So this is an opportunity for you to ask as many questions as possible. If you are a parent, a guardian, or even a potential parent, it's important for you to be prepared. So, JJ, what are the lessons to be learned from the 2020 stock market performance?
Yeah, 2020 was a year where we, if you didn't know anything going in about the markets, but you were an investor, you learned some lessons very quickly. So I'd say something you had said early in the show was, maybe you learned that the stock market's very risky and it was a bad experience, or maybe it was wonderful because you made a lot of money. And a lot of that's going to depend on whether you were invested at the beginning of the year or you were invested from April to the end of the year. Because if you weren't following along because you were watching the rest of life happening, the stock market went way down as COVID started at the beginning of the year, and it went down in as violently as it has in history for that shorter period of time, and then it bounced way back up and kept going very quickly as well when nobody really thought it would, because of COVID and all of the global economy really coming to a standstill. And so if you had been invested coming into the year and hadn't done anything differently, you saw your account values go down precipitously. And so you may have had a gut check at that point and said, there's a lot of people that panicked and said, you know what, I can't do this. This is too risky. This is not for me. And I'm out. And so you had a lot of people really learn about risk if they hadn't before. But you also had a lot of folks that maybe had never entered the market before that started to enter the market at that point in time, because you had a lot of people at home. And so there is a group of folks that, their first experience with the market was 2020, and it wasn't at the beginning of the year. It was later on in the year. And you saw, pretty steady climb in most stock markets from April through today. And so there were some little pockets along the way where it went down, but for the most part, it was pretty strong. And so, depending on whether you had both of those experiences or just one of those, you might have a different take on risk. And so, I guess, didn't mean to be so long-winded, but the first lesson we learned was how quickly risk happens. Risk happens extraordinarily fast. The line is that the stock market will take the stairs up and the elevator down, and we kind of saw that. And so the first lesson I'd say to learn is that, to me, the first most important lesson in investing is to have a cash reserve first, and to not have all of your money just in the stock market, unless you've got such, just so much money that you don't really care what the market does. I mean, for most people, you need to have a good cash reserve, emergency fund, whatever you want to call it, 3 months, 6 months of cash that of your expenses set aside, because then when the market does its thing, because the markets are going to move up and down violently at times, you don't have to worry about it because you can be a long-term investor. If you are not able to take losses because it'll ruin your life, then you shouldn't have that much money in the market. You should only put enough money in the market that if things get really bad, it's not going to ruin your life. And so, over time, as you get older, that can become a bigger amount because you have your cash cushion and you can put a little bit more in risk, a little bit more at risk, and you can leave it alone and let it grow. But if you're first starting out and things are tight and you think, well, I'm going to make some money in the market to alleviate this tightness, that's not how you do it. You're doing it wrong. I mean, you're gonna get yourself in trouble, because what will happen is at some point the market's not going to be good. You're going to panic because you need that money, and you're going to sell because you're emotionally not going to be able to handle it. And so you have to set yourself up for emotional success, knowing that you're dealing with a hot stove, knowing that needs to be handled with care. And so have a cash cushion going in so that you can put little bits away, a little bit away, a little bit away, and just keep doing that over and over and over until that little bit turns into a lot. But you can take the risk, because if the market goes down 50%, it doesn't ruin your life. And that's just the most important thing, is you should never put yourself in a situation where the stock market is going to ruin your life. It should be something that you use as a tool to help grow the money you've saved at a higher rate than you could get otherwise. But you have to respect the risk first. So that's the lesson we learned from 2020, is to respect that risk, but also at the same time, if you did it that way, if you could leave that money alone for 4 or 5 years, you had a better psychological state that maybe you didn't panic sell at the bottom, and maybe even had a little bit of cash on the sidelines that you could put a little bit extra in to your accounts when everybody else was running away.
I totally agree with you. A lot of people we saw, they did panic selling, whereby they got into shock when they saw the stock prices going down, and most of the brokerage companies, they are out there to make money, not to help you with your panic anxiety. So they made a lot of people to sell their stocks at a very, very low rate, which if you come to think about it, the same people, if they could have been patient a little bit, maybe they could have gotten to enjoy some return at some point in some few years time. And I also like the point that you said, it's important for you to respect the risk. That is the king in stock market. Learn to respect the risk, because it is the risk that defines your capability, or how much you're willing to put, and you can lose it without losing your life. We go to the next question. What do you think uh, will happen to the stock market in 2021, now that we've seen what happened in 2020? And as a wealth manager, I believe you do a lot of forecasting, so maybe you could just highlight to us what are your thoughts about the 2021 stock market.
Yeah, absolutely. And I think that the first where I'll start with that is, let's be mindful of the lessons that we maybe learned in 2020. And one of those lessons is the unpredictability of it. And so just like we respect risk, anybody that does any level of forecasting and has done it for any length of time has been wrong, plenty of times. I mean, if you make forecasts, you're going to be wrong. That's part of it. And so you respect that as well. You respect that unknown that is always out there when you're dealing with, with business and with risk assets. And so the way I approach 21 is just mindful of how 2020 went, that even if you'd have known that, COVID is going to reaccelerate later in the year, Would you have been a good investor with that information? No, you'd have probably got it wrong, because it have probably made you be really conservative, and you wouldn't have put money in the markets because, hey, COVID's going to reaccelerate. Well, guess what? The market didn't care. And so
Yeah.
I just, anything I do, I always start with the answer is what's going to happen 2021. I don't know. And none of us do. And I think we all know that. That being said, I think that it's really important that we not just get set on this mentality that what just happened is going to keep happening. And you have to approach 21 the way you do any other day or week or year, is that respect the risk of the markets. And we could see, we could see big volatility again, and it wouldn't surprise anybody that I know, myself included. And so I think you have to be very cautious because of how far we've come. Does that mean you take your money out because the market's going to go down? JJ says it's going to go. No, I'm not saying that at all. I'm saying I don't know. But what I'm doing with my clients is we're staying a little more diversified than maybe we would have been, 7 or 8 months ago, just wanting to make sure that we, that we don't have everything in one space that's going to take on too much risk. So we're approaching it with caution. That being said, respecting the resiliency you've seen in the market, despite all of the stuff that's been thrown at it. I mean, we've had the COVID, we've had elections in the United States with some pretty high temperatures around that, and unknown about changes in government. And here, the market just keeps chugging along. And so you have to, some will say, is that complacency or resiliency? And I tend to always err on the side of resiliency. There's certainly some complacency out there, but feel like, you don't want to get in the habit of changing your plans every single year. You want to stick to that plan. I mean, you figure out how much is at risk, how much not at risk, and allocate appropriately. To get a little bit granular, with clients, we are keeping our eye on, things that can help bond investors out, because interest rates are very low. And folks that live on fixed income, it's tough to expect too much out of a bond portfolio for the next few years with rates this low. And so we're kind of mindful of what are other asset classes that give good yield, that maybe take on a little bit more risk than bonds, but have some room to appreciate because the market's yield starved. The market is extremely yield starved. And so you saw some scenarios in previous years, 2015, where a lot of these bond market equivalent type stocks did pretty well, and a company that can grow dividends is doing pretty well. So we've had a pretty keen eye on the dividend growers over the last 12 months, really. Wasn't so popular through a lot of last year for pieces of portfolio, but going forward, feel like that's a place that we'll see some rotation to. I've lost you, Sheila. I think I'm still live, but I think that I have lost my host. Let's see. I turned my phone off, so I don't know if you're communicating with me. Yeah, she's back. I was getting ready to ad lib. You're back.
No, I'm so sorry. I lost my connection. I really apologize for that. But we are back now. So I believe you were just telling us on matters of forecasting. Maybe you could repeat the last sentence because I didn't get it. I'm so sorry.
And no worries at all. I was about to ask myself another question, so we were going to keep going without you. But no, I just talked about a little bit about 21, and one theme that I had kind of finished speaking about was 2020 was a lot of the growth companies did really well, and a lot of the companies that were growing earnings, or maybe didn't have earnings, but not so much your dividend payers. Those growth companies did well. And one pocket of the market, kind of what we're thinking about, is with rates this low, with bond returns, not a lot of expectation there because interest rates are so low. We're just keeping our eye on things that we feel like people that are frustrated with bonds might want to buy. And so, where we land are a lot of the companies that are the dividend paying stocks, but the ones that have shown histories of being able to really grow their dividend year in, year out for a long period of time. So that's one theme that we've had our eye on for the last 12 months and have continued to be pretty happy with. Just feeling like, the NASDAQ has done well. We certainly have exposure to tech names and all of that, and we want to maintain that exposure. But if there's something we would want to add to kind of spread that, diversify that out, make sure that we're not just riding that one wave, it's those dividend growers.
Yeah, that is very, very true. Especially, there's something you said that forecasting always has some errors, and I think it's very important when you are setting up your investment plan, especially for the stock market, allow yourself some allowance or risk allowance or risk tolerance. You cannot be 100% sure that the market will go up or will go down. So it's very important for our investors or anyone planning to invest in the stock market to give him or herself some allowance. And this leads us to our next question. What should one consider before buying stocks? Because we've seen a lot of people, and as well as a lot of adverts. If you log in on YouTube, whichever social media account you try to log in, there's always a pop-up: invest in this stock market, invest in this stock, buy this stock. What should one consider before making that choice of committing their money? As an advisor, would you recommend?
Yeah, I think that the perfect thing to talk about here would be the difference between trading and investing, because they're very different strategies, different ways of going about it, and they're very different probabilities of success. And a lot of the hype, the exciting videos, TikTok videos, and you name the platform, you'll find it. It's a lot of people selling stuff. There's a lot of fraud out there. You have to be really careful. Anybody telling you you're going to get rich quick, be very leery of that, because if it were that easy, then everybody would do it. And so you have to be aware of, anybody that's saying, hey, we're going to do this quickly in a short period of time. You're probably being sold something. So you really want to have your guard up, because it's just usually not that easy. So there's trading and then there's investing. And I think it's really important that we differentiate between the two, because you're bombarded with it and you might not know already. And so when you're talking about trading, you're implying moving in, moving out. I'm going to buy this, I'm going to sell that. Maybe I'll own it for days, maybe I'll own it for hours, maybe I'll own it for weeks or months. But it implies some level of moving in and out and being active and trying to catch short-term gains. And compare that to investing. Investing, you tend to not have a lot of buying and selling. In fact, you might just buy it and leave it alone for 20 years. You might never touch it for 20 years. In fact, if you're doing it right, that's probably what you're doing. And so investing, it implies a longer period of time that you're going to hold that asset. It implies that you kind of do the long-term hold. And millions and millions and millions of people in history with no training, no extra education, didn't know what they were doing really, have been very successful investing by just buying a little bit every time they get some money, buying a little bit more every time they get some money, and then leaving it alone over long periods of time. Maybe make some changes here and there along the way if something's not going quite right. But for the most part, you don't touch it a lot. And millions of people with no education, no training have been extraordinarily successful by doing just that. Versus trading, there are people who have been extraordinarily successful trading, and some got lucky, and some have developed a very specialized skill where they are able to move in and out, sometimes over days, weeks, months. There's different levels of trading. But what I'll tell you from experience, having studied both investors and traders, very deeply, those that have been successful trading didn't get there because they clicked on a TikTok video. They got there because they spent 18-hour days doing nothing but studying it for years on end. And even then they might not have been successful, because it's a very specialized skill. And so the first thing I would say is kind of figure out who you're trying to be. And if you're trying to be the trader, well, you need to study it like a science, and you need to treat it with the respect it deserves, because 99.9% of people that try it fail. And people that study like a science, it's a very high probability of failing. And so are you in that camp? Maybe you are. God bless you if you are. I wish you nothing but luck, but know yourself and know who you are. And you're probably more likely to be successful as an investor. And honestly, even the best traders, they're also investors. So where they put money away and they leave it alone. And so the reason I bring that up is because you're just getting bombarded with people saying it's easy. Because markets have gone up, it makes it look easy. But just be careful and understand that it's not easy. But if you can just put a little bit away into, and there's the other thing I should probably bring up is there's a difference between owning the whole market and owning individual stocks. And I think that that's important to differentiate. One of your guests that you had, Will Rainey, I love Will. And he's a big advocate of, don't let kids buy individual stocks. He says, just, have them put it into an index fund. And I don't disagree with him that most of the money that is saved and invested should go into some sort of fund, something that is diversified. It doesn't just own one company. It might own 300, 400, 500 companies at once. That way, if your particular company falls out of favor, it doesn't, you don't lose all your money. But I do think it's important to talk to kids about individual companies, even if they don't buy individual stocks, because I think it helps them be critical thinkers, to kind of watch the marketplace in action, to be able to see, all right, I know this company and I've watched it do different things and adapt to the marketplace. I think it's really healthy to talk about those, companies on that level with kids, and also acknowledge that, they're publicly traded, and you can, their share price does matter, because, not all these kids are going to grow up to, to just be, people that only buy index funds. Some of these kids are going to grow up to manage publicly traded companies. It's important for them to understand how share prices do impact how the company is run to some level. So I'd say, just, kind of to come back to, what should you do before investing and buying stocks? Kind of decide what type of investor you want to be, and how hands-on do you want to be, and how deep do you want to take it? 9 out of 10 people don't want to take it very deep. That's the whole point of me writing my book, is most people don't want to go that deep, but you can still take care of yourself and really use the market as a tool to help you, achieve your goals. If you treat it with the respect that it deserves, and approach it from that investing standpoint.
Yeah, actually, I totally agree with you. People need to know. I always say you need to know if you are an active investor or a passive investor. Now, most people are passive investors, but they don't know they are passive investors. So they want to be active investors. But if you check their risk tolerance, it's very, very low. If this person puts their $100 in a stock market, they will not sleep. They keep on checking, has it gone up, has it gone down? This clearly tells you that this person has a low risk tolerance, and you see their emotions changing every time the stock is going down, another time it's going up. So knowing the kind of an investor you are is very important. And I like the point you said that the stock market is not something that you just click on a TikTok video and you become rich tomorrow.
Right.
That is the biggest lie that you can ever buy in, because it's better you take time and understand. Not all videos that are out there really mean that the thing is easy to do. It's easy to be done when you have done your research. Especially in investing, do your research. I wanted us to talk about Forex because you mentioned about trading, but do you want to say something about it?
Yeah, and I'm glad you brought that up actually, because
Yeah.
that's the other thing that the young people are being bombarded with. Because when I talk to teenagers, they ask me about that,
Mm.
and I put it in the same camp as the trading mentality. I mean, if you're doing Forex, unless you own a company and you're hedging currencies because you actually have a reason to hedge currencies and you're playing with Forex, you're trading and you're gambling. There are professional poker players. There are professional, gamblers. Again, are you going to become a professional Forex trader over easily? No, probably not. You're going to have to study it like anything else. And so just understand that like anything else is a very highly specialized skill, and treat it with the respect it deserves, because Forex, I mean, you can lose all of your money just like that. I'm a student of the markets and have been, for 30 years. And Forex is it's the Wild West on a lot of levels. And so you have to really, in my opinion, know what you're doing, and be careful. I mean, that's one in particular that I've never studied in depth in terms of the intricacies. I've studied charting, so there's not to go into this, but there is the science of studying charts of stocks and companies and Forex. And so I understand a lot of that, but I've never traded Forex myself. But it's like anything that has the word trading with it. It's extraordinarily risky. And there's a good chance that the person on the other side of the screen knows a little bit more than you and is waiting for you to do exactly what they know you're going to do. And you have no idea that it's happening. So anybody that develops the skill, God bless you. I wish you nothing but the best, but just nothing is easy.
I tell you, JJ, you know what?
I mean, crypto. Put the crypto stuff, the Bitcoins and the Ethereum and all of that. I mean, it's all in that same bucket of, highly risky, highly speculative. And, if you want to do that, I don't want to say don't do it, but just understand you want to do it in small amounts because your chances of success are quite low. And if it is, a lot of these things, if it is, going to grow the rate they say, then a small amount will still make you a lot of, will still make you money. So just, you don't have to make big bets. And that's one of the things that, talking to beginner investors is don't feel like, all right, if I have $1,000, I have to put it all on one thing. Maybe you have as 1,000, well, maybe it's okay to do it in smaller pieces. Even, professional traders, professional investors, they'll all say, one of the biggest mistakes you can make is position size, meaning how big's your bet. And so it's okay to make small bets until you're comfortable and until you have more cushion, and then you feel a little more comfortable. Then you can, gradually, just keep putting a little bit more money away. But it's okay to start small.
Yeah, and I actually agree with you. I always say diversification is the only free lunch when it comes to investing. You don't put all your money in one thing. Just try to put small amount to different things, and then try to see how you are performing or how you are adapting. Then you keep increasing the amount. And about forex and Bitcoin and all that, I totally agree with you. If anyone wants to um, invest in that, be ready to spend more of your time studying it, because it requires a lot of time to study and become well knowledgeable or well researched when it comes to forex and bitcoins and all those things. But if, and of course, most people don't want to study because you don't have that time. For example, if you're doing a 9 to 5, have the time, where will you have the time to come and study about forex for maybe 4 hours or 5 hours a day? You need to sleep, you need to spend time with family. So if you have the time, then start with studying very well. But if you don't have the time, then just do investing and stop trading, right?
Yep, yep, yep. And if you do want to go down the path of trading, then
Mm,
don't sign up to some subscription to something you clicked on from that says he's gonna, he or she's gonna make you thousands of percent.
mm,
Read the books from the
mm,
best traders in history that,
mhm,
a lot of them are, 50 years old. Study from the best, not from some huckster that's just trying to get your $100 a month or $20 a month or whatever.
mm,
There's books that have stood the test of time on the subject,
mm, mm,
that you should go to. And until you kind of, start to recognize some of the terminology and the names and kind of how it works, and then you may be
mm,
more comfortable, subscribing to something. But don't just the first thing you do subscribe to something that you clicked on. Put some thought into it. And you can always reach out to me. I'm on social media, pretty easy
yeah.
to find if you are interested in the subject of trading, because it's a thing. It's out there and it's not going to go away. And I think it's important that we acknowledge it.
Mhm,
But study from the masters like William O'Neill and Mark Minervini, um, and others, that if you catch me on my Twitter feed, you'll see me talking that side of things a little bit more frequently. Um,
yeah.
but it's a specialized thing, and it needs to be, like I've said maybe too many times, it just needs to be treated like a specialized thing.
Yeah, and actually, the best knowledge is hidden in books, not on click here. And a lot of people don't want to read; they just want to click and get results. But when it comes to investing and especially wealth creation, you need to spend time reading from the people who've already charted that path, instead of just looking at a video on TikTok and then clicking, then subscribing, then going to sleep expecting your money to double up. That's just a joke. And we have Elegant Flora Event Services. I believe she's from Kenya, Africa, and she's saying, wonderful. Thank you so much, Jane, for tuning in. We hope you are learning something. If you have any question, and as well as to our other audience, this is the time you need to start writing up. If you have any question regarding trading, investing, especially in the stock market, you could ask our very honorable guest, JJ, who is a wealth manager and founder of Wenrich Wealth Management Company, as well as an author of the book Teaching Kids How to Buy Stocks. I don't know why I'm forgetting this topic. I think it's because it's very long, the topic of your book.
The
So,
subtitle, yeah, the subtitle is Stories and Lessons for Grown-ups. And that's that's the fine print, is that it's not a book that you can just give to your kids and then tell them to hand you back all the money. It's one that it's actually meant for moms and dads, or even people that don't have kids. It's the
Yeah.
finance book for people who don't want to read a finance book.
Yeah. Yeah, and actually from the reviews that I've seen, I believe it's very interactive. As I've seen most people saying how they it got them on their toes, especially grown-ups. It's not a storybook for Tom and Jerry that you buy and throw it to your kids. It's more interactive that requires both of you to participate in it. So speaking of that, JJ, how does one teach kids how to invest in the stock market?
Yeah, it really starts with just talking to them about money. And
Mm-hmm.
as you know, as they're growing up, helping them understand the value of money, teaching them how to save, and just having those personal finance lessons that really need to be taught in the home. Otherwise, they may not get taught. And then from there, as we had talked earlier, it's about helping them recognize companies and businesses. You know, if you are at a store or you're dining out, you know, talk about how the business makes money, just so that they can kind of start to see the world from the point of view of the business owner, or you know, the you know, of the business, not just the consumer. And then eventually, as kids get older, you start to talk to them about the fact that some of these are public and some are not, and so you can actually save your money and become an owner in some of these companies, or you can own, you know, all of the companies at once by owning some sort of fund. And so the way you teach your kids is just by talking to them as they're growing up, as they're going through their life. It's not like you sit down and have these, you know, we're going to have our stock market lessons. It's not that at all. It's, you know, my kids love to play video games, and you know, we talk about the companies that are involved in the, you know, in the video games that they play, whether it be the, you know, the computers, or, you know, for example, Roblox is a game that they play a lot. You know, Roblox is going to go public in the next couple of months, meaning it's going to have stock that anybody can buy or sell. And so, you know, we'll talk about that, and we'll talk about, you know, what do you think Roblox does with that platform? Do you think they can grow that? Do you know, and we just have those conversations about, you know, not do you think this stock is going to go from 20 to 30? It's more of, what do you think this company is going to do next? And do you think that this thing that they're about to launch is going to be popular? You know, when Nintendo came out with the Switch, we were talking to the kids. You know, we had talked about, you know, they knew what a stock was. It's not like they followed it or anything. They just knew that there were these things out there called stocks. But we talked about Nintendo, and we said, you know, they're coming out with this thing called the Switch. Do you think that this is something that's going to be popular? And I said, yeah, all my friends are excited about that. So just making it relative to their world. And then maybe you do show them, hey, by the way, here's what happened, you know, last Christmas when the Switch came out, and you show them the stock price. So it's just having conversations about businesses and companies, helping them be aware of the importance of saving money. I mean, really, the most important things aren't talking about stocks and companies. It's teaching them how to spend less than they bring in. That's I mean, that's the most important thing in personal finance, is if you can handle the psychology to not just spend everything you get. I mean, obviously, you know, if you're in a poverty situation where you may not have that luxury, but anything you can do to keep your standard of living below your income level, and that anything you can save, I mean, that's where it starts. It doesn't matter if you know how to pick stocks if you spend everything you make. So
I totally agree with you. If you're not able to manage your current finance, if you're not living within your means, then chances are high you will not survive in the stock market. You'll not manage the investing in the stock market, because the discipline starts with how you manage even your own budget. And this goes down to teaching kids. Don't bombard them with a lot of let's talk about stocks, let's start investing. Give them the psychology of learning to save before spending. Then from there, you can take them step by step, as well as I think I saw in one of your posts or something where it was mentioning that it's also important to kids, they have certain things that they like. Maybe it's a shoe from a certain company. So if they like that shoe or that product, you could start talking to them about that company, so that when they reach a certain age, you can buy for them, so that when they put on that shoe, they also feel like, I also own this company. So you're giving them an analogy, you make them feel the ownership side of the stock market as they grow. And this leads me to our next question. What are the key terms that one should know when investing in stocks? The reason I think this question is very good is a lot of people have been swindled money because of jargons in the stock markets. So you find someone coming up with a very difficult jargon and puts it out there. And since people want to, make money, or they just have money and they're looking for somewhere to invest, they fall prey of the wrong people. So maybe you could highlight to us, what are the major words or terms that one needs to know when they are getting in the stock market?
Yeah, so I mean, I guess it depends on whether you're talking about if you're working with somebody that as an advisor, someone that's going to help you. I mean, the most important thing to ask is what's it going to cost, and make sure you understand. Is it are there fees associated, fees to get in, fees to get out, and I always say if you can get a referral from someone that's trusted, that helps. But ask more than one person, shop around, get advice from multiple. I mean, I tell people that are shopping me the same thing. You want to get a lot of opinions. As far as the kind of the terminology, I mean, just on the kind of the stock market level, the first three terms that I cover with the kids and with anybody is just helping them understand the price per share, that and the share. The share represents the share of ownership. And that if you take all of the shares for a company, add them up and multiply it by the stock price, that's how much the whole company is worth. Figure, if you and I have a company and you've got 50 shares and I have 50 shares, and we, it's $100, then, we each have that percentage. You add it all up, and that's the whole value of the company. Well, same thing with the stock market. So stock price, the share price, and the next kind of step of terminology is the dividend, helping them understand. The next terminology is the dividend is the cash portion of a company's earnings that they pay to shareholders. So if a stock is $10 per share and they pay a $1 cash dividend, it means that if you have a share of that, you got $1. That's kind of the first level. But when it comes to kind of avoiding being, taken advantage of, to me, that usually has to do with fees and the costs associated with things. And then the next level up when it comes to terminology, and I always try to break this down to make it simple, is earnings. There's a line I use in my book and that I've used for a long time. It's, stocks follow earnings. And what I mean by that is, over the long term, the price of a stock is going to tend to follow the path of their earnings or their profits. Another word for earnings is the profits. That's the whole goal of business, is to, if we can sell something for 10 that we paid for 3 for, we made $7. Same thing with companies, is they're trying to be profitable. And so that's kind of the next level up. And that's when you start to look at individual companies, is you start to look at how much are they selling, what are their profits, and what's the path going forward, kind of that forecasting thing. In the end, if stocks are just companies, do you want the restaurant that has a line out the door, or do you want you want to own the restaurant where the owner is, looking down the street wondering where all the customers are? Same thing with this. You want to own the stock of the business who has line of customers, out the door.
I like that analogy, JJ. It's very interesting, especially a restaurant where the owner is standing at the door looking at how the customers are doing. But yeah, it comes back to learning the key terms. And I like the fact that you are able to differentiate earnings and dividends, because that is one of the things that most people really confuse themselves in. And so they end up telling you, I bought stocks for company ABC. Why are they not giving me dividends? Then you come to realize that company doesn't give out dividends. Instead, they just give earnings. So it's very important for people to know this. And maybe you could tell us more about bearish and bullish market as we are about to wind up.
Yeah. I mean, just generic terminology for the direction that someone thinks stocks are going to go. If you're bullish, you think the market is going to go up. If you're bearish, you think that things are going to go down. I mean, I even have cufflinks on. I have a bear and I have a bull on each hand because I'm weird like that. I like bulls and bears. The legend is that when bulls attack, they attack upward with their horns, and bears, when they attack downward with their claws. I don't know if that has anything to do with the truth behind why we say bullish and bearish, but it makes a good story, so I guess we'll go with it. But that's the legend as to why we say, bullish for when we think things are going to go up, and bearish when we think things are going to go down, is because the way they attack.
Exactly. And I like how simple you've made it. I believe our audience has learned it, because this is a term that has been ongoing, especially with the pandemic. At some point, you could hear like the stock market is now in a bullish state, or at some point, you could hear the stock market is getting to a bearish state. So I believe our audience has learned. And if you have any question, feel free to write to us right now as we are about to end. I can see Jane, you're saying, welcome, I'm learning, dear ones. Thank you so much for learning. And I believe you're going to put into action. So our last question, Zay, what advice would you give to beginners planning to invest in stock market, or just anyone, especially anyone who's looking into investing in the global stock market?
I'd say that the first thing, as we've talked about, is understand how you feel about risk. Just try to really get a clear picture in your own mind, and you may learn on the fly a little bit, but understand how you feel about losing money, because that's, risk almost makes it sound like it doesn't hurt, but it's losing money. Make sure you understand how you feel about losing money, and then decide how much time you want to really spend on it. How much do you want to have this be a part of your life? Or do you want this to just be something out of sight, out of mind? Chances of success are probably higher if it's out of sight, out of mind, but you still just put a little bit of money away. And so I think the next thing is, just decide how involved you want to be with it. Decide how active or passive you want to be, and then choose an appropriate strategy. For most people, that's going to be more passive. And then, based on that, look to increase your knowledge to whatever level you need to based on that strategy. If it's passive, you may not need to increase your knowledge level a ton. You can be successful without having to take classes and know a million different things. Just it all kind of goes hand in hand. Just understand who you are and how involved you want to be with it, so that you can choose the appropriate path to go down.
Yeah, that is very true. Especially understanding your risk tolerance is very important, and know how you feel anytime you are losing money. Because a lot of people, they'll tell you, it's fine, I'm ready to lose money. But when it really happens in reality, they get more affected than even when they didn't they had not invested. So it's good to know yourself, know thyself very well with money before you rush into stock market. As JJ advised us earlier, it's a highly volatile investment, or highly risky. So it's not something I always say, don't buy stock with your grocery money. If if you have some money set aside for your grocery, just because you saw an advert saying people are making money in the stock market, don't rush with that money to buy, because it's a very risky market, but it also has high returns for those who are patient enough. So that brings us to the end of the show. And to our audience, if you have any question, feel free to write it in the comment box, and we'll try our best to reach out to JJ in case there will be anyone watching later on and they might be having a question that needs to be addressed by JJ. So to bring us to our end, maybe JJ, you could share with us your contact details and how people can get to you as well as get to your book so that they can learn more.
Yep, absolutely. So I am on social media, on Twitter. Both myself and the book have accounts. So mine is J.J Wenrich, the number 2. So at J.J Wenrich 2 on Twitter, and then at Teach Kids Stocks with an X is the book. And then you'll find us on Instagram and Facebook as well under Teaching Kids to Buy Stocks. And you can find the book internationally. It is a little bit more difficult. It is available on Amazon if Amazon is in your area. It is on barnesandnoble.com and some other the US type retailers. But I have heard it's a little bit more difficult to get on internationally than it is here in the States. But just a lot of it's going to depend on whether Amazon delivers where you are or not. Kidstobystocks.com is the website. Again, that's teachingkidstobystocks.com. And our email is jj@teachingkidstobystocks.com. So any of those methods, you should be able to get a hold of us, and we'd love to hear from you.
All right. Thank you so much for sharing your contact. I believe people will check you out. And as well as he has a podcast. I think it's under Teaching Kids to Buy Stocks. As you want to say something more about it?
Yeah. So it's on our website as well. The name of the podcast is Piggy Banks to Wall Street. And we're 10 episodes in, and what we've done is we actually ask people like you, Sheila, to be our guests. We talk to folks that are experts on financial education. We've had people that have written children's books about teaching financial literacy. We had a CEO of a company that has financial literacy technology. So we try to stick within financial education, but bring a wide variety of guests. So you'll find information on that on our website as well. You'll see the Piggy Banks to Wall Street logo on the top left of the website.
Absolutely. Thank you so much, JJ, for being with us throughout this session. I have personally learned a lot from you, and I believe our audience has also learned so much. And God willing, maybe we can get some time later on in the year to bring you again on board now to talk more about kids and stock, so that we can as well cater that side of the audience. So to our audience, thank you so much for being with us throughout this session. We really appreciate your patience and being here to learn from J.J Wenrich. As he mentioned, you can always find him on Instagram, Twitter, or check out his website so that you can listen to more of his podcast. So with that said, we encourage you to press the subscribe button, ensure you turn the notification on our channel, and follow us on Instagram and Facebook, Financial Wellness Center. So till then, we'll see you next Thursday. Keep safe and make sure you're becoming financially healthy. Goodbye.